Hey guys, this is AI Mike Zlotnik, not the real Big Mike. Thanks for watching. I love sharing what I've learned about real estate investing over the years, and I'd like to keep you in the loop. Subscribe to the channel for more of my take, and if you want to see the deals we're working on, head over to tempofunding.com.
Hey folks, this is Big Mike Zlotnik, and today's conversation is all about deep value investing strategy. Before we dive into this, I'd like to ask you to subscribe to our channel, turn on the notifications. I hope you enjoy this presentation. Thank you. So what is deep value investing in general? We go to the godfathers of investing, Benjamin Graham, Charlie Munger, Warren Buffett. And one of the most fundamental principles is all about getting a great value for the price you pay. Great intrinsic value, as some of the wise men tell us. And the reason that comparison is the only comparison that you need to keep in mind is that you could get a cheap price and buy garbage, or you could pay a very expensive price and buy more valuable diamonds. So it's not about the absolute price that you pay. It's about the value that you get. This is a very important concept applicable to buying stocks, bonds, real estate, commodities. It's all relevant and relative. It's all relative to the price that you pay. If you get a great value for the price you pay, that's what you seek when you invest in value investing strategy. So let's apply this to commercial real estate now. And the reason it's important is that there are great deep value opportunities available in commercial real estate today. Why? Well, because the market has reset. When the Fed pushed rates up fast and furious and kept interest rates higher for longer, they have reset commercial real estate market valuations. And today we find ourselves with phenomenal deep value buy opportunities relative to the intrinsic value relative to the cost. So let me give you some examples how we look at this. When I give you our primary underwriting box, how we look at these opportunities. First of all, we start with strong, predictable cash flow from day one. That's the condition number one. And I'll be specific. There's a mathematical way to look at this. The way you look from mathematics perspective is you look at return on your investment without any leverage. In real estate, there is a term that we use called capitalization rate, cap rate, and it simply means what yield do you get on your investment if you were to buy it completely for cash without any mortgage leverage. So if you bought an asset for $10 million and it gave you $800,000 worth of income, you divide the $800,000 by 10 million that you paid. That's the cap rate. This example, the cap rate, capitalization rate is 8%. So if you took no mortgage, you would get 8% yield on your investment. That's not bad, right? Well, that's not enough. Well, what is the level of current interest rates? And the level of current interest rates, say you could borrow at 6%. Then you have a positive spread between your capitalization rate of 8% and 6% mortgage rate. When you have a spread of 2% or better, that means strong cash flow deal. Another very important element, I started the whole conversation with strong, predictable cash flow. How do you get strong, predictable cash flow? Well, you look at the underlying tenants in the property that are paying you rent. Do you have an industrial tenant, industrial property that has a long-term predictable lease with a high credit quality tenant? That doesn't guarantee, but it's highly of the future cash flows. It's close to being guaranteed. As long as the tenant is doing well for long term and their credit is good, their business is good, you're highly likely to receive those rents not only today, but the years to come with the rent growth. So predictability of the cash flow really depends on the quality of the tenants. If you look at the shopping plaza, same issue applies. Who are the tenants? How good is their credit? How long have they been there? And as you go to that underwriting, you can gain high confidence in the predictability of the cash flow. It's a simple mathematical approach of 2% positive spread between the capitalization rate and the mortgage rate, especially when the mortgage rate is fixed for years to come. Next, we look at well below reconstruction cost, the acquisition at a well below reconstruction. How do you look at this? Well, give you an example. We did a deal early in the year where we bought the property for approximately $79,000 a door, multifamily. You could have 1,000 doors times 79,000 a door, it's 79 million, right? As an example. So we paid 79,000 a door for a property. And in that property, reconstruction cost approaches 200,000 a door if you were to build something new like this. So what does it signal? It signals that you're getting a deep discount to the reconstruction price. Now, condition of the property matters, of course. If you're getting a property completely run down, that's one thing. But if you're getting a property in pretty good shape at a steep discount to the reconstruction cost, then you're well ahead of anyone who is going to build new. Your ability to do well is almost guaranteed by the fact that whoever builds new property, they're going to pay a lot more per door. Their cost is going to be way higher, and you have a much better competitive situation. So that's the number two. Now we go to condition number three. Condition number three is a deep discount and a motivated seller today. So motivated seller means one of these few things. One, the seller is taking heavy financial pressures. They can't pay the mortgage. They are squeezed. They have liquidity squeezed. They have financial pressures because they bought the property at the wrong time and their mortgage rate is too high. They can't refinance it. They can't keep paying floating rate mortgage. It's one of those conditions. Or the seller, somebody passed away, or there's a divorce, or there is breakup of partners. So any of these conditions could create a very strong motivated seller situation where they need to sell, and the timing is bad for them, but the timing is great for us. So that's how it functions. The other way to look at this is how much discount are you getting to where the prices used to be at the peak of the market. Why this matters? Well, the reason it matters is that we know what the market corrected approximately at. And if you're trying to get a relative valuation, are you getting a good price or not, you typically look at the current comps. You look at what's trading today and at what price. But when the transaction volume is low, you may not see wide range of comps. So what you wind up looking at is a few distressed transaction comps and a normal market transaction comps. And of course, you want to see a deep discount when you buy distressed versus a normal market transaction. So that's what you're looking for on the as-is basis. But you're still comparing to what the prices were at the peak of the market. And you're getting, typically today, we see in multifamily, it depends on the asset class, of course, location, many other factors. But in multifamily, many markets, we see discounts between 20 and 40%. So an example that I gave earlier, the property we acquired early in the year at $79,000 a door. It used to trade for $125,000 a door at the peak of the market 3 years ago, roughly. So that gives you approximately 35% discount. Is that enough? Well, it's pretty close to being enough. If you combine all these three factors, as I mentioned, strong positive cash flow with at least 2% positive spread between the cap rate and the interest rate, deep discount to the reconstruction price, and then a deep discount to the peak of the market and a motivated seller. Now, that's not a guarantee of a success, but it's a high probabilistic scenario where you are ahead. You're getting a great intrinsic value relative to the price you're paying. Of course, you have to conduct good due diligence and full underwriting. But if you look at these factors, at least it gives you an idea. Are you getting likely a great deal? And should you spend more time digging into the underwriting and better understanding related strategies, what other value add the property can execute, what else you can do, how else can you improve the property? All those factors matter, of course. But what matters most is getting a great buy, great deep value. I gave example of commercial real estate. The reason we love it is because it's actually not that difficult to underwrite. When somebody's telling you get a deep, great value, some cryptocurrency or deep value on some speculative investment where I don't know what the cash flow is going to look like over the years to come. There's a lot of speculation. This is how we look at investment. Deep value investments is what we're looking for, not speculation, but deep value investment. I appreciate your time and attention. I hope this was helpful. I'm grateful for you to subscribing to the channel. If you like this, please share with your friends and click like. And until the next time, thank you so much.